Well, we always expect something new in markets, and what we've seen overnight is absolutely unprecedented. You're with us here on a fresh new edition of Bazaar Morning Call. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, markets did not celebrate Diwali that well. I think we're going to have another Diwali, right? It's just crazy what we've seen overnight. Unprecedented moves, really. I think there is no other way to put it. 7.5% move on the Nasdaq, the S&P 500 about 5.5%. I could detail for you, this is the biggest since when, but then we'll have to go a long time because these are unprecedented. 6% fall in US yields across the board, across tenors, 2-year, 5-year, 10-year, 30-year. On the 10-year, that translates to a 28 basis point fall. The dollar index fell 2.5%. The rupee in offshore markets is indicating a big gap higher, and the SGX Nifty is indicating a 300-point higher start. I mean, I think we're going to push out of that congestion zone we've been talking about for the last 6 or 7 days. 18,413 on the SGX Nifty futures. It's going to be a good day in trade today. Sonia, hi. Nigel, hi.
It's going to be a good Friday, right?
Yeah.
I mean, after the match yesterday, I think this is the balm that
we needed this.
Yeah.
Right?
Yeah. We track only markets.
We don't watch the match anymore.
Selectively.
Okay, but I mean, great for the Bulls today. It's going to be a big one, at least at the start. Now, here's the big headline, right? The US consumer prices, they rose by 0.4% in October. It was less than what the street was estimating. So that's where the big 1,200-point bump up came in from for the Dow, the S&P 500, the biggest one-day rally since 2009. Now, this smaller than expected rise in the consumer price index is it's giving hopes that perhaps inflation may be cooling. These are just hopes at the moment that if inflation cools off, it's still nowhere near the targeted 2% range by the Fed. But if inflation cools off, then perhaps the Fed may not need to be as aggressive in terms of rate hikes. The treasury yields fell sharply, as Prashant was also pointing out. But for our own markets, there is a bit of a congestion zone around this 18,300 mark. So let's see if that gets conquered today. The FI flows have dried up a bit. So, that's something you also keep on your radar. But we get this data monthly from the mutual fund space. And what stood out for me over there is that SIP inflows have crossed 13,000 crores for the first time ever. So this equity cult, at least as far as retail investors are concerned, that continues. And I think that's a big positive over there. So, of course, a bumper opening is what we're looking at. But the global arena also looks quite stable.
I would say it looks very volatile in a positive way, Sonia, right? I mean, they say that the biggest rallies also happen in bear markets. But a near 8% rally, I mean, I've tracked markets since, 2003, 2004. 7-8% kind of single-day moves on the back of data, it's rare. I mean, let me put it that way. And it's not just the equity rally. Let me just quickly emphasize, because the moves are so large, I think it bears repeating. The S&P 500 is up 5.5%. The Nasdaq is up 7.3%. As I said, Treasury yields fell 6%, right? These are, U.S. Treasury government bond yields I'm talking about. The 10-year lost 28 basis points. Market is priced the Fed's terminal rate. And this has been the problem. Where does the Fed rate peak out at? Is it 5%, 5.5%? It's fallen now to 4.9% after the consumer price inflation data. The dollar index fell 2.4%. It's at an important level, at the 20-week moving average on the dollar index. And I think if the dollar stays even here, that's great news. Look at the other currency moves. The Japanese yen, the British pound, 4%, 3%, 3.5% moves on some of these currencies. So this is very large volatility in a positive way. Now, what from here is the question, I think, which all of us will sort of wait and watch. So tonight we get the Michigan inflation expectations data. So you got one more inflation data you got to get by. But after today, all the way till the first week of December, there is not very much, right? Very limited info. So it's a bit of in that sense, a clean run. You'll hear from the Fed officials. By the way, overnight, you heard from 5 Fed officials and all said that all basically repeated what we heard from the Fed chair that, there is no loosening as of now. We need CPI numbers. And by the way, all the speakers spoke after the inflation numbers. So there was no let off from the Fed speakers, but the market did what it did. Dollar peaking process may play out from now all the way through 2023. I made this point on the last Editors Roundtable as well. The bulk of the rate hikes, both in US, in India as well, given where inflation is, perhaps is behind us. It's not ahead of us. So hopefully, dollar peaking process will start. It's unlikely to be a straight line. It never is. It'll be a volatile process. I mean, it's foolhardy to expect that after 7% kind of days, the market goes into a very gentle kind of, phase and the market trends higher slowly. It's going to be volatile. You will get big days like what we saw overnight. But cooling US inflation is also positive news for India's macros, right? The simple interest rate differentials, and if interest rates don't move too much higher in the US, I mean, the pressure on India, Indian rates are about, 3% higher. That also cools off. It comes off. It helps the rupee. The offshore market is indicating a big gap. And I think the concerns about imported inflation, etc., also take a bit of a backseat. Eases the pressure of the RBI to try and defend the rupee. In terms of sectors, I think with the big 7% move in the Nasdaq, IT stocks perhaps have a bit of a tailwind. The dollar has fallen very hard. The fundamental picture for commodities, I would say, is not that great. But just because you've seen this outsized move in the dollar, metals perhaps are something you should watch out for. And as I said earlier, new highs are a matter of time for the Nifty, for the Bank Nifty. The Nifty, of course, at 18,604, which was the October 2021 highs. Maybe not today, but maybe next week. The Nifty Bank, we already made a new high. We cooled off a little bit, so watch out for that as well. Nigel.
Well, that 18,350, 18,400, I think for the last couple of weeks, we've been talking about that being a bit of a resistance. So with the kind of cues we have, the big question is, will that be, conquered finally? And the ingredients are in place because the Nifty is going to be starting above that 18,400 mark for the first time all the way since 20th of October. Pretty good news out there. The dollar index, that's cooled off, and that's a big tailwind for emerging markets like India as well. The FIs, yesterday they added some short positions and they unwound some long positions out there. And just take a look at the way the short positioning has moved up from around 41% at the start of the series. It's moved to around 47%. Those shorts that they added of 11,000 contracts, that's a blessing in disguise because the flows have dried up. The FI flows, well, they have tempered down quite a bit. And now the institutional flows number, that's the DI and the FI number put together, that was a net sell number yesterday, close to around 950 crores odd, which is a bit of a worry. But these shorts in the system will give that additional fillip that's required. On the option side, well, there was writing that was seen at around that 18,000 put and the 18,000 call as well. Now, the call writers, particularly the 18,000 call writers, the premium yesterday was 150 rupees. At the start of the day, it was 250 rupees. They're going to be forced to close out some positions. So keep an eye out on the 18,000 call. And we see some unwinding out there. That's telling you they're packing their bags and moving out. Levels to track, a close above 18,350. That's on the bulls' wish list for sure. Start is well in the green. We have a firm support in the near term at around 17,850 to around that 18,000 odd mark. SGX Nifty, Sonia, is flying away. 300, triple century to kickstart trade. The bull's wish has come through. Can we end around these levels? That's the big question.
Okay, if not now, then when, right? Yeah. I mean, it's the bull's time today. That's the only way to put it. And all-time highs in just a matter of days, perhaps, is what you're expecting on the Nifty. Could it be today? Only time will tell. But on the equities front, we have lots of commentary coming in. So let's get straight to that. First up, Chris Wood of Jefferies says that one change will be made this week in the Asia-Pacific ex-Japan relative return portfolio. He says the weight in China will be reduced by 1 percentage point, while the weight in India will be increased by 1 percentage point to maintain the overweight. So that's important. Jefferies there increasing their India weight.
Well, money market views from Bhaskar Panda of HDFC Bank, who says in the US, the CPI reading came out lower, prompting a huge correction in the dollar index, and US yield stocks have rallied, and the prevailing positive risk sentiment in Asia is expected to aid INR appreciation today. He expects another gap down in the dollar-INR pair, taking cues from overseas markets today. He expects that pair to trade in a range of between 80.5 and 81.8.
And on the bonds, Bhaskar Panda says the Indian bond yields will also get influenced by the sudden drop in US yields overnight. He expects the 10-year benchmark yield to trade in a range of 7.25 to 7.35% for the day.
Well, we have a lot of stock-specific action to track for you besides the markets. Well, and we'll get to that in just a bit in our top 10 segment. We'll look at Eicher Motors, Apollo Hospitals, Zomato, Indian Hotels, Ashok Leyland, as well as Berger Paints. Well, they are stocks that should be reacting to positive news flow. While you have Bata, Trent, JSPL, Muthoot Finance, they are stocks that could open up in the red. But given the kind of market situation that we're likely to open up to, let's see how long they stay in the red.
most important to get the global setup, and we have some very special guests joining us to help us do that. Jahangir Aziz is Head of Emerging Markets, Economics Research and Commodities at JP Morgan. Arvind Sanger is Managing Partner at Geosphere Capital Management, who is joining in as well. Gentlemen, great to have both of you here. Thank you very much for your time. You know, markets are markets, Jahangir. The 20 basis point miss in the core CPI inflation number, sparking a near, 8% rally in the NASDAQ. Just square that for us, Jahangir. And what did you make of the price action? Let's begin there.
Look, the market clearly reacted to the fact that the core inflation was lower than what was expected. And that sort of reinforced the idea that the door to a step down in Fed rate hike in December would be open. Remember, the Fed said that if the data supports, they would step it down. But, one needs to remember in all of this, euphoria, one needs to remember that the non-farm payroll just 2 weeks back was actually stronger than expected. The labor market is slowing, but not slowing as quickly as the Fed would like. And on top of that, one also needs to remember that the Fed made it very clear that even if the pace was a step down, the level of a Fed funds rate would be much higher. And I think that, we might get a 50 basis points rate hike in December, but I think we will have to brace for a much higher rate, which will be in restrictive territory for a much longer period of time.
Okay, so a much higher rate. What do you see as the way forward then, Jahangir? Back home here, I mean, what do you think the RBI could do? Are we also all set for higher rates? And from a long-term standpoint, right, from a macro standpoint, do you think at some point perhaps we've peaked in this cycle, not only in the US, but in India as well, in the rate hiking cycle?
I think in the US, clearly we haven't peaked. There's a long way to go. And I think in the case of India, I think the task is much harder. I mean, if you look at the amount of macro risk India is bearing at this point in time, so let's define macro risk as the sum of the current account deficit, which is running at 4%. You have a fiscal deficit that's running around 11%. You have inflation that's running at 7%. And the only compensation that the investor gets is about 7.5% in the 10-year yield. That is not what normal emerging market countries compensate for macro risk. I think the amount of compensation that India is offering for foreign investors to come in to India, given the macro risk, is too little. And therefore, I think you will find pressures on the currency, not today. Today will be a great day, absolutely. But the pressures on the currency continuing as long as India continues to have these high current account deficits and fiscal deficits.
Hi, Jahangir. Morning. I want to talk about the currency space itself. The dollar index went flying away to around 115, and that's cooled off. So do you think this is just a cool off and we get back towards, those elevated levels? Yeah. And what about the rupee? At around 83 odd, do you think it's peaked out, or do you think it still has higher levels to visit?
Again, if you look at what are the big drivers of dollar, right? I mean, the U.S. most likely is going to continue to widen its growth differential with the rest of the world. China is going to perform, pretty badly in the fourth quarter and probably also in the first quarter. Europe is going into a contraction. So the growth differential of the U.S. with the rest of the world is actually going in favor of the U.S. On top of that, the interest rate differential, and I'm not talking about the pace of rate hikes, but the level of rate hikes is clearly going to widen again. And therefore, if both the growth differential as well as the interest rate differential is going in favor of the US, it is very difficult to see that the dollar is actually peaked. Most likely, the peak is still ahead of us. We will go through these bumps, but clearly the level of dollar where the dollar can go is the peak of the dollar is still ahead of us. And given the fact that the peak of dollar is ahead of us, and given the fact that, as I pointed out, India does not provide enough amount of compensation for the very significant macro risk, given the size of the current account deficit, size of the fiscal deficit, and the inflation, it is very hard to see that the rupee actually is bottoming out at these levels and starting to appreciate. that's a very, very difficult path ahead.
You know, Arvind Sanger is with us as well. Jahangir, you know, the market pricing of the Fed's terminal rate fell to 4.9. You're saying it's going to be much higher?
Look, you know, we had 475 to 5. 4.9 is somewhere between 475 and 5. We'll have to wait and see how the non-farm payrolls, the labor market behaves in the in the next few months.
Right.
And you know, the risk that we have is probably a higher rate than 5, then lower rate.
All right.
Let's put it that way.
Fair enough. Arvind Sanger is with us as well. Arvind, thanks very much for joining us. It's an important day with very large moves that we are responding to. We will respond to. But how do you look at these moves themselves? Are these very large outsized rallies in what has been a very entrenched bear market in the US? Or do you think this is the start or reversal?
I think, you know, clearly we don't know, as I've said in the past, what is a bear market rally and what's the start of a bull market. But clearly today the hope is that the inflation cycle worst is decisively behind us and that inflation can come down rapidly and Fed is towards the end of its rate hiking cycle. So that's a bull case, right? The bull case is that we can have a Goldilocks scenario, inflation comes down, rates go up to, you know, whatever, 4.5 to 4.75 to 5, and we don't go into a recession and everything turns out fine. I remain of the view that there's a much higher probability that the optimistic scenario will turn out to be just that, too optimistic, and that we will end up having to deal with more trenchant inflation, which might require slightly higher rates, and that with the risk of a recession quite high, markets could roll back over. But you know, that's a U.S. story. From an India story standpoint, if U.S. is not going into a terrible recession, then Indian earnings cycle is on a solid footing. It will have to watch what is going on in the rest of the world. But you know, you could have China doing better next year. Europe is already in a stagflation. It could be doing a little better sometime in 23. U.S. could be going into a recession. So there's no clear answer on how the global cues in 23 competing with each other will play out and how that will impact India. My sense is India is kind of, not cheap by any stretch, but one of the few places where people are able to hide out with earnings risk much less than in many other parts of the world.
Is there an outsized gain for this market, Arvind, that we're looking at, the Indian market particularly? Because now the global risks seem to be abating. Maybe the worst of the rate hike cycle is not done just yet, but at some point it will be. And you have earnings improving as well. So are we looking at a big rally in the Indian markets over the next, say, 6 to 12 months?
I think we're looking at a decent rally in the next 6 to 12 months if that comes to pass. But I don't see India, which has been the star performer this year, being the short-term star performer. I think there are other markets like China that are hugely oversold that could actually have a bigger rally off the bottom if zero COVID goes away than India would. But if I look at India over the next 3 years, if I take a more medium-term view, again, if I were to make a relative call, India has one of the better sustainable growth stories with a lot of benefit from, friend-shoring away from China benefiting India, as well as a lot of, macroeconomic fundamentals, assuming inflation in India is not going to go out of control, providing support. So I think the Indian story may not be the rocket ship from here, but it's already been the best performing major emerging market. So I think it can continue to perform, and that's the way we are thinking about it.
Okay, all right. So India is a pick, because of it offers earnings growth. But Arvind, I just wanted to ask you, I recall a month or so ago you were telling us that for the global markets, for the US market, this is a pullback in a bear market actually. We've seen a big rally out there. Do you want to change your stance now? Or do you believe that this is the actual thing?
No, bear markets don't end with dramatic rallies. Bear markets end with apathy and fear. And maybe we got the fear in the last few months, but as I said a few minutes ago, I still think that the U.S. having a recession in 23 remains the greater probability. And if that is the case, then a one-day rally on better than expected inflation numbers does not suggest anything other than just a massive positioning reversal because a lot of people were short and a lot of people were underweight the market. It doesn't suggest that the risks of a recession have disappeared, and therefore the risks of a market going down again have disappeared.
Both of you are not pouring cold water.
It's called tempering the enthusiasm, right?
I think that is important, right? I mean, otherwise you get carried away. Markets get carried away, and they will overdo it at some point. But the question is, at what point does that overdoing happen, and how long before we get to that point? So interesting views from both. Jahangir, in the US, there is this political change, which is also a little bit of political change which is underway. There's no red wave as many were expecting. Are there any implications for policy, etc., at all? Briefly, yeah.
No, I mean, right now, it is still up in the air. I mean, we don't even know which way the Senate has gone, which way the House has gone. So it's very difficult to say, where that means anything for policy going forward. But I think there are just this year itself, even in the lame duck session, there are a couple of important milestones. I mean, there is the continuing resolution problem. There is a debt limit problem. So even if we are not talking about the big things, right, on climate change policy or immigration, etc. But I think there is already something that needs to be addressed, and the composition of the House and the Senate, especially the House, will matter in the case of the changing the debt limit and for the and for the resolution to go through. So I think there are important implications, even if I don't go into politics, to which way the House and the Senate falls. And we don't know anything about it.
Well, we don't know anything about anything, right? At the end of the day, it's all just a guessing game here. Sorry, I didn't get that, Jahangir. What did you say?
I was saying that, but in answer to your first questions that we were pouring cold water, both Arvind and I, today will be a great day. So at least take one day at a time.
Well, if you wake up on the right side of the bed, every day is a good day, right? Thanks a lot, Arvind and Jahangir,
that's good.
For joining us, and have a good one. Have a great weekend. Fridays are always a good day, right? Because you're heading into a weekend. But that's the word coming in from Geosphere and JP Morgan. Don't be too exuberant in a market like this. The valuations in India are on the expensive side.
It's a very simple way to look at things, but the fact is that the US was in an entrenched bear market, whereas we are at a newer high.
Yes.
So 8% rally on the Nasdaq isn't going to be a 8% rally here, because you're not down 25% from highs like the US is, right?
Yeah.
So I think that's one of the points which both Jahangir and Arvind also made. But what this does is it takes away this global pressure, this continuous global pressure. If this were to last, that is, right? It's just one day, but we'll see. Asian markets are on your screen. They'll just come up on your screen. I think we've got, 4.5% rallies. But this is also made up of markets like Hang Seng, which are so beaten down, which are seeing a bit of a bounce back. But Taiwan and Hang Seng on your screens. SGX is also indicating a 1.8, 1.9% kind of a move. We'll take a quick break here. We are back. Our list of top stocks to watch out for, and lots of them on the other side.
Welcome back to Bazaar Morning Call. Well, we are bracing for a fantastic start to trade, but there are a lot of stocks that you'll be tracking as well, a lot of numbers to react to. Well, Sonia, you go first. Our team is standing by to run us through the top 10 stocks that we're looking at. Sonia, Eicher Motors, good numbers?
It's good set of numbers. We were talking about the new Meteor, right? Wow. And those 5 pictures there. It's looking pretty good there. But this time around in their numbers, the market share in the 125cc segment has gone up. 125cc plus segment, which they operate in. Now it stands at 30% versus 26% same time last year. So that's the big positive over there. Overall as well, if you look at the numbers, right, no faulting it. I mean, volume growth of almost 60% is what you're seeing for Eicher Motors at 392,000 units. You have the revenue growth has been very healthy in this quarter, largely in line with estimates. No surprises either way. 56% growth. Margins have picked up on a year-on-year basis. EBITDA growth has been solid as well, and profit growth nothing to complain, largely in line with expectations. The only problem is on a quarter-on-quarter basis, the margins have fallen over 100 basis points. Now that's because of a higher share of the low-margin Hunter sales. Now the Hunter has done very well, but it's a lower margin product. So the question is, will they be able to offset this this dilution in margins with the lower raw material costs, So can they offset it? That's the big question that we need to monitor that, and whether a higher scale and lower input prices can offset the margin dilution. But brokerages are quite sanguine. Morgan Stanley says this is a good approach where they are focusing now more on volumes than on margins. So I'm going with green on the stock.
Okay, green on Eicher Motors. Then we'll wait by for that launch meteor here in India. But let's hop across to Ekta. Ekta, how was Apollo Hospitals numbers?
Well, actually not a bad set of numbers because the revenue was up 14%. The street was anticipating a 6% growth this time. The margins came in at 13% versus 16.5% year on year, but it was in line with estimates of around 13.5% and profit over 200 odd crores, so that was not too bad either. Now, healthcare services, which is basically the bread and butter hospitals business, revenue was up 5% on a year-on-year basis. It was up 12% on a Q-on-Q basis. EBIT margins also improved, but what probably got the numbers lower, especially on the margins, was the digital health and pharmacy space, where there was an EBIT loss, which was higher on a Q-on-Q basis. Retail and diagnostics, which is basically Apollo Health and Lifestyle, the revenue was up around 9% and margins improved around 200 basis points on a Q-on-Q basis as well. So overall, looking good for Apollo on the top line front, but maybe it is a little bit of a concern with regards to what's going to take place on the digital health and the pharmacy space. Call is at 2 p.m. this afternoon.
Okay, we'll await more details on that, but let's go across to Mangalam now. He's going to talk about our favorite subject, travel. Indian hotels on his radar, and also food, of course. The other favorite, Zomato, is what he's looking at. Mangalam, over to you.
Travel and food, both doing well. You know, for the Indian hotels, it's a seasonally weak quarter, but in that as well, the streak of good performance continues for the company. Importantly, we've seen, growth above pre-pandemic levels as well. Quarter on quarter, there has been a decline, but that's primarily on account of seasonality. A 69% jump in the revenues, 300% plus jump in the EBITDAs, and the company has reported a profit as against a loss same time last year, and lower finance costs has also aided their business. Importantly, occupancy at 70% is higher than pre-pandemic levels, and also revenue per available room is 134% of pre-pandemic levels itself. The stock close to a record high, but importantly, the third quarter is likely to be the best quarter in the history of the company, and its inclusion in MSCI will further aid the stock. For Zomato, the best part about the numbers for me this time around was the quality of disclosures, and operational metrics have improved even as the pace of growth comes off. And that's because the company said that they are strategically choosing to trade low-quality growth for better unit economics, and they've reiterated that their adjusted EBITDA loss will actually break even in the next 2 to 4 quarters. Adjusted revenue for the company has grown 16.5% quarter-on-quarter. Even if you strip Blinkit consolidation up, it's about 9%. But importantly, the food delivery business has broken even on a quarterly basis. It had broken even earlier as well, but they did a technical adjustment and improved their disclosures, and even on those disclosures, the food business has broken even. The company believes this will sustain.
All right, this is interesting. New age businesses, new age companies. I mean, the guidance is changing to a bit of a positive now. Sonia, Ashok Leyland should be in focus today.
A very good set of numbers coming in from Ashok Leyland. So I'm going with green on that stock as well. If you look at it, it's a beat on all parameters for Ashok Leyland. Revenue growth is 85%. Of course, there was a low base of last year, but even as per the poll, it's much higher. EBITDA has come in at 536 crores. The poll was 480 crores. The margins have picked up to about 6.4%. And if we can get a trend on the screen, kind of a bar chart, you'll realize that after languishing in about 4% for many quarters, Q4 was a bit of an aberration, but it was 3-4% for many quarters. Now it's back to 6.4%, and that's something that the street will like. And the market share as well has improved to about 32% as of Q2. So I'm going with a bright green over there.
Okay, all right, Sonia, bringing us some good news this morning. So we'll keep an eye out on both those two stocks. But Mangalam, coming back to you, Bata and Trent, you're not too impressed?
Well, for Bata, the problem is that raw material costs continue to haunt the company, and that's what we saw across the footwear space as well. Bata's revenues were marginally better than expectations, 830 odd crores versus the street expectations of just around 790 crores. But the EBITDA, there was a miss of almost 40 crores versus street expectations. And when you miss that, the net profit also is a 40 crore miss, as a result of which it's coming at 55 crores versus a 90 crore poll. Gross margins have improved for them. The company said that they saw tough operating environment in the mass category categories there's been sluggishness, but what's doing well for them are sneakers because they continue to lead momentum for the company and they have higher margins as well. For Trent as well, the revenues grew about 66%, but the EBITDA margins, they compressed almost 500 basis points, as a result of which the net profit was just about flat. Why is it that the margins declined by 470 basis points? 200 basis points gross margin compression, 200 basis points higher rent expenses, and 90 basis points higher employee costs. So, the focus on Trent will now be the third quarter as against the second quarter.
Okay, all right. Mangalam, thanks for that. Well, I'm focusing on JSPL, and the numbers looked a little bit disappointing. You're looking at the absolute EBITDA number, you'll see it was a beat, but you need to adjust it because there was a forex element out there. And adjusted EBITDA was a miss. They had a forex gain of close to around 400 crores out, so you need to take that out of the way. And the standalone EBITDA per ton is what we look at. That came in at around 7,100 rupees per ton. That's the much lower than most on the street actually were working with. We had an expectation of close to around 9,000 rupees odd. The positive though is that they've reduced net debt by close to around 700 crores, which is good news. But operational performance lacking a little bit. So expect the stock to start in the red, and then we know metals are firing. So we'll take it from there. Well, Abhishek joins us to tell us about Muthoot Finance. Abhishek, how are those numbers?
Well, Nigel, a few months back I had mentioned in my Fin Street that gold financing NBFCs are losing customers to banks, and over the last 2 quarters we are seeing that playing out. So Muthoot Finance is losing customers to bank. The AUM growth is one of the lowest that you are seeing in last 20 quarters in terms of YOY. So YOY growth is at just 3.8%. In that, the gold AUM has grown by just 3.3% YOY and about 0.6% sequentially. However, the gold customer base, that is down nearly 3.85% on a YOY basis. Net interest margin has improved by 30-40 basis points given the fact that cost of funds have reduced for them. Subsidiary performance are weak. Housing finance is under pressure for 7th quarter in a row. They'll continue to lose customers both YOY and quarter-on-quarter, which is leading to decline in AUM both YOY and quarter-on-quarter. The Bellstar MFI that they have for a 3rd quarter in a row, it's seeing increase in the gross NP ratio, which is now at 8.5% versus 7.3% in the previous quarter. So in terms of our poll, both the NI and PAT has come in below our poll. We have CLS's note on Muthoot Finance. They have an underperformance rating with the target price of 1200. However, for FY23 to 25, they have cut the EPS estimate anywhere between 7 to 8%. So expect a weak opening for Muthoot Finance in trade today. Back to you.
Okay, thanks a lot for that. Weak opening for Muthoot Finance. But you heard from Mangalam earlier about how people are traveling more and eating more food. But are they painting their homes a lot more? Let's find out. Mangalam, you're tracking Berger Paints?
I am tracking Berger Paints, and this time around they've done well as well in terms of revenue. 20% jump in the revenue, but that hasn't, like all the other paint companies, reflected into their EBITDA. Despite a 20% growth in revenue, the EBITDA has grown just about 3% and that's on account of lower gross margins. The net profit as a result of which has been flat. What's heartening, however, is just like all other paint companies as well, they expect margins to improve in the second half because we've seen, some sort of cooling off in inflation for raw material, and they've increased their market share by about 80 basis points, and they've announced capex as well. My sense is that Nigel keeps talking about how cement companies are increasing their capacity because of one large player coming in, and that's what paint companies are doing as well. They have a UP facility which is coming on stream, and they have 30 acres of land that they've acquired in West Bengal for another 175 crore capex plan.
Okay, all right. Mangalam, thanks for that. And we'll hear from the management later on in the next 1 hour or so. But for the time being, let's do a quick recap then of all the stocks we just covered. Stocks with positive news flow: Eicher Motors, Apollo Hospitals, Zomato, Indian Hotels, Ashok Leyland, and Berger Paints. While stocks with negative news flow include Bata, Trent, JSPL, and Muthoot Finance.
Okay, so that's about all the stocks to watch, but there was so much action that happened overnight in the commodity market. Manisha Gupta is joining in. Manisha, yesterday you were tracking cryptos. What is it today?
Oh, I'm looking at gold and silver today, Sonia, because what a strong run-up overnight with the U.S. inflation growing at a slower pace, the U.S. dollar index declining by 2%, the U.S. 10-year Treasury yield slipping to a one-month lows as well, clearly boosted the enthusiasm here. So you have the gold prices now trading at an 11-week high. We've seen 2.5% of gains here. Silver gained up by 3%, platinum was up 5.5%, and the industrial metals did well too. So you have the copper prices which are now trading at a 19-week highs. Nickel prices gained up by 4% overnight. Zinc was up 2.5%. So metals it is that really took it with both hands. The decline in dollar index doing great too.
All right, Manisha, thank you very much for that. By the way, gold prices have also made a what is basically a double bottom. It should technically head to all the way to about 1800 or so. We'll see. It's flattered to deceive in the past. We'll see if this happens this time. Muthoot numbers were weak. Abhishek was telling us, but maybe the rally in gold perhaps supports it a little bit. We'll take a quick break here. Deepan Mehta, director at Elixir Equities, will be joining us on the other side for some stock-specific talk. Important this morning, Mitesh Thakkar and Shrikant Chauhan will also be joining us to discuss some technical trading ideas. That's also coming up in a bit.
Welcome back. It's time now to talk about some numbers. We have Deepan Mehta, Director at Elixir Equities, who's joining in. Deepan, hi. Good morning. It promises to be a big bang opening this morning, but I wanted your thoughts on individual stocks. What do you do with a name like Zomato now? Because, the operational metrics are improving. A lot of these platform companies are now talking about a path to profitability. Do you like either Zomato or any of the other names in this space?
Sonia, good morning, and thank you for having me on your show. And maybe finally we can say that अच्छे दिन आ गए हैं, especially for the stock markets and Indian investors with markets trading at all-time high and very good interest coming through in mid-cap stocks as well. About Zomato and some of the new age digital companies, I think we remain quite optimistic and positive. It's just that the time horizon has to be a little longer. You need them to be around, holding period has to be at least around 3 to 5 years from today as well, because these companies are still evolving their business model. They're trying to go towards profitability. And as and when they reach those destinations and goals, I think markets will reward them. There's no denying the fact that these are outstanding businesses. It's just that valuation is a bit of a mystery and confusing how to, value them. But by and large, there's no doubt that the long-term growth prospects are excellent. I thought Zomato numbers were very good. As for Nykaa, as well as PB Fintech, the common thread, of course, is the road to profitability. And as and when that takes place, you'll see a higher and higher valuation for these companies.
Hi Deepan, morning. The auto space has been buzzing around, and Sonia just told us about two companies that came out with good numbers, relatively good numbers, and they've increased their market share as well. Eicher Motors as well as Ashok Leyland, both from different segments. Are you bullish on any of these two?
Absolutely. I think within the auto space, you have to largely be in the four-wheeler space. And only two-wheeler company that's worth mentioning is Eicher Motors, because it has a differentiated product business and great export opportunity, and it's an aspirational brand. And that's what differentiates it from Bajaj Auto or Hero MotoCorp or TVS, which are going to be disrupted increasingly by EVs, especially EV scooters. On the four-wheeler side, the threat of disruption is a little less, at least in India. And we are seeing excellent numbers coming through from the likes of Maruti and M&M. And of course, within commercial vehicle space, Ashok Leyland also came out with a very good set of numbers. Valuations are reasonable. And after, I think, multi-year downtrend within the industry, we are seeing a reasonably good uptick in volumes and margins. I think this trend is sustainable for the next 2-3 years or so. So I would reckon that most auto companies are going to be great outperformers going forward. There could be a few exceptions, maybe like a Tata Motors or so. But by and large, this is a sector to be invested in.
Deepan, hi. Good morning. We had, just to go back to the market point, you said, Achhe Din, maybe, Diwali back with the big rally in overnight markets, and hopefully that is correct. Although we had Jahangir Aziz and Arvind Sanger this morning saying, well, maybe let's take it one day at a time and not too soon. In any case, two names, Deepan, Piramal Enterprises and Piramal Pharma, right? Both are, Piramal Enterprises sold off massively after the results. Numbers were disappointment. And Piramal Pharma, of course, has lost quite a bit since listing separately. Your thoughts?
Yeah, I think both companies, as a measure of disclosure, we are invested in, and bit of a disappointment, especially the way the NPAs are ballooning. You always thought that they were over and done with the provisioning, but then some more has come through. And maybe this is the last major round of unusual provisioning which will take place as far as the financing business is concerned. And as and when we would see the retail business starting to scale up, some of the threats would reduce for Piramal. And at the same time, we would see higher net interest margins. But let's just wait and see how the actual business evolves. Pharma, I haven't really got a handle as to why the loss has come through. And on the whole, it's a great business. Very steady cash flows over there, good expansion plans, and really a strong point for the group as a whole. So a bit surprised over there. But these are, I think, great businesses. If you remain invested in them for the next 2-3 years, they should turn around pretty well and start to perform well. The time to sell is gone considering the kind of correction which we have seen in these companies. And maybe you could, if you can look at a 4-5% type of a downside from here, then the upsides could be pretty decent 2-3 years down the line.
So look beyond the very near term, good solid franchises with good pedigree. Well, Mitesh Thakkar and Shrikant Chauhan are joining us now for some technical trading ideas as well. Deepan stays on. Mitesh, what would you do? I mean, we get a gap up, about a 150, 200 point gap up. Chase it or wait for intraday dips?
You know, Prashant, yesterday we didn't buy with the dip because we were not sure whether we'll see a recovery immediately. Though the last hour was slightly on the positive side, but the overall day was negative. And the hourly chart setup is not very positive. But with today's gap up, I think things could change. I think 18,200 would be the level where we can, I think approximately around those levels where we'll see this opening. And if that happens, and if we see continuation, then I think, we'll take a long with a 65, 70 point kind of a stop on the Nifty and look at possibly this time 18,350 being tested. But in case we open and stay below 18,200, then I'll wait for some kind of an intraday dip to buy.
But is there any reason for this dip to come, right? I mean, that's the question. Shrikant Chauhan is also with us, the EVP at Kotak Securities. Shrikant, a gap up is a given, going by what the SGX is suggesting. But then what? Do you think we can build on to our gains? Do you think we can hit new highs today? And if yes, what's the strategy?
Good morning, Prashant. Good morning, Surya. I think, yeah, see, like the markets are going to cross 18,300 levels. And the reason is because yesterday, despite the market breadth was extremely weak, the market managed to sustain above the crucial, important psychological level of 18,000. Today, if we go through with the macro factors, then based on that, markets are going to cross the level of 18,300. That's the overall view. And as Mitesh said, yes, despite that, if the market fails to cross 18,300, then it will keep the market in the range. But broadly, we are expecting markets are heading towards the levels of 18,500. So the strategy should be to buy even if there is any correction during the day. We are now expecting 18,000 to act as a very good support for the market. And if we if we try to correlate this with the Bank Nifty, then we may even see the levels of 42,500 or 42,800 on the Bank Nifty.
Okay, all right, Shrikant, then go ahead and give us your picks as well.
In the past, whenever the market recovered from the lower levels or whenever it opened up with a gap, we saw most of the time activity in all the HDFC companies. So today also we are expecting further more activity in HDFC Bank and HDFC Limited. We are expecting HDFC Bank to move towards 1600 in the near term. We can keep stop loss around 1480. And also we like HDFC Limited, which is around 2500. There we are expecting 2650 on the high side. And from the defense sector, we like Bharat Dynamics, which is around 960, 980. There we are expecting 1060, 1070. We should look for adding this BDL at current levels with a stop loss around 920.
Right. Well, Mitesh, how about you? What would the stock ideas be from your end?
So I have HDFC on my bank on my list as well. I think that's clearly a stock which is showing good strength and possibly now playing some catch up with the run up which you've seen in the PSU banking name. So HDFC Bank is a buy with a stop below 1509 for targets of 1560. That about Hero Motors is a buy with a stop at 2689 for targets of 2765, and GSPL is a buy with a stop at 229 for targets of 246. I've kept one sell call in case the market does not get past 18,200 post the opening. Then we'll attempt that. GNFC is a sell with a stop at 686 for targets of 650.
Okay, all right, gentlemen. Thanks so much for that. For the time being, we'll slip into a short break. You come back, we'll get chatting with Mr. Ramesh Kalyana, the Executive Director at Kalyan Jewelers. Stay with us. Welcome back. Well, let's get straight to the management of Kalyan Jewelers. It's the first corporate that we have on the show. And the company clocked in, pretty good set of numbers, 20% revenue growth versus last year. But they say that high competitive intensity, that's what led to lower gross margins for the past quarter. Key positive, though, is that Kalyan Jewelers came out with a strong update for the festive season as well, with around 25% growth. To understand more about the outlook from here on, we're joined by Mr. Ramesh Kalyana, the Executive Director at the company. Hi, Ramesh. Morning. Congratulations on a pretty good showing. I want to ask you a couple of points out here. One is, what was your studded share, in quarter two? If you could give us a sense out there. Where do you see that number headed? And also your market share. You've been talking about increasing it, right? What was it and where is it headed?
Yeah, so first of all, Q2 has been good. We are extremely happy with the outcome. Studded ratio is improving year on year and quarter on quarter. If you look at a consolidated studded ratio, it would be in the range of 23%. If you are talking about India business, the studded ratio is 26% in Q2. And this is also a function of the stores which we have in the non-South region. We have been expanding outside South India, and all the new showrooms which we opened this financial year is also outside South India. And of course, there is a natural shift to the studded segment as well. So our focus will be to increase the studded ratio in the coming quarters as well as in the future years.
Okay. There is a big boom that we're seeing in weddings in India, right? And a big chunk of your earnings comes from there. I mean, I was just reading a report which said that there are 32 lakh weddings in India within the last 41 days. I'm sure you're making the most of that. So just tell us, how does this reflect on your own earnings, say for the full year as well as for FY24?
So as we have updated, the Diwali minus 30 days revenue, which we have recorded is approximately 25%, which itself comes from a very high base of Q3 last year. Q3 was fantastic last year as well, right? And we would have absorbed some of this wedding demand in the Diwali festive itself.
Okay.
But yes, November, December again is very, very crucial for the wedding segment. Our team is geared up. The inventory is also focused on the wedding segment products. The campaigns are also focused to that. And but of course, we should not keep 25% revenue growth as a benchmark for Q3, because Q3 we are already starting with a very high base. But we believe that it will be a good double-digit growth. And as a brand, our wedding segment revenue is usually in the range of 55%. So the target revenue is also wedding focused, and we believe that Q3 will be ended.
So when you say double-digit growth, you've done in the first half, I think, revenues of a little over 6,800 crores overall. Is that a level that you can maintain? Can you do better than that in the second half?
So usually Q3 is a bit more heavier than Q1 in terms of revenue. So that's all I can tell you.
Okay, but it's interesting. Ramesh, hi, good morning. You're saying that some of this huge wedding-related demand could have already happened, right, in the quarter that you've reported numbers for, but Q3 will be better. You had indicated this pilot franchise stores. I think you'd opened one in, I believe, Aurangabad, and the last time you'd said that you'd open 5 more before Diwali. What's the progress there, and what are sales looking like here?
So as we speak, we have already opened 5 franchisee stores in India, and we are extremely happy with the outcome. The revenue momentum there, the operation module there, and it's almost set now. And we have now signed 6 more LOIs for franchise in India. We have also signed up the first LOI for Middle East operations franchise, and we are extremely bullish on the franchisee momentum which we are getting across. We are already in talks with 50 odd franchisee partners, prospective franchisee partners, and our expansion will be majorly driven by the capital efficient franchisee module, and that's the franchisee update.
So, Ramesh, is this like one large player, or each store is a different franchisee? I mean,
each store is now different franchisee.
Okay. Is that hard to manage? Is that hard to manage, or not really?
No, but we have a ecosystem which can nothing to manage as well, because meaning it's only updates which we have to give to them, etc. Because it's a FOCO model. The store is managed by us.
Okay.
Ramesh, you've mentioned that competitive intensity, that's what's hurt gross margins. Is that easing a little bit? And also, what's the outlook on margins for the second half of this year?
So gross margins, actually, we improved by around 0.2% when you compare with the previous year-on-year, quarter-on-quarter also. Quarter-on-quarter, there's a dip, but it's not actually comparable between quarters.
Right, but Ramesh, the reason I ask you this is because you'll have mentioned there was some competitive intensity. So give us further details out, yeah? Is that easing gradually and the margin outlook? Go ahead.
No, competitive intensity is very high, but our studded ratio increase, etc., we are able to negate the margin, gross margin impact substantially, right? And if you're talking about the EBITDA margins, if you look at Q2 last year, actually the advertisement expenses started from a very low base because we were just coming from the Q1 impact of lockdown. And this quarter, we have a one-time provision done. And if you negate both of them, the EBITDA margins would have been in the range of 8.1 to 8.2. And that is the way to look at it.
With 8.1, 8.2 from here on?
That's I will not be able to give a guidance, but that is the actual figure if you negate the one-time provision which we have done and the ad expenses which was not there in Q2 last year, and we had to do this year. We had to start the campaigns also earlier in Q2 because Diwali was early this year, so we had to start the campaigns by September second week.
Little unfair, the provision I take it, but higher ad cost, we cannot exclude that. That will have to be taken into your operating margins, Mr. Ramesh. Final question, what's the debt in the books? Is there a reduction plan out there?
So again, just to clarify on the advertisement, we had to start our campaigns a bit more earlier this year because Diwali was early this year.
Okay.
So it is not an actual Q2 impact on the advertisement. It is actually a Diwali campaign which was preponed because of the Diwali which is coming earlier this quarter. And regarding, you were asking about the debt. Yes, we have a reduction in gross debt by around 100 crore and gross debt around 50 crore and net debt around 100 crore. But we have now a debt reduction plan as well for the next 3 years because as a brand now, as I told you, the franchisee arm is almost stabilized and we are having very good traction on the franchisee momentum. Our expansion will be now majorly driven by franchisee, which will bring in a lot of free cash in the books for the next 3 years. We will be targeting to reduce our debts, which is majorly the cash credit, which we'll be reducing because that comes with a higher interest cost.
Okay, so double-digit growth by end of FY23. You're looking at double-digit market share as well?
So market share, again, that it depends upon how much you are present across the country. But as a brand, we always try to become the number 1, number 2, number 3 player in the micro markets where we are. And the SSG has also been strong. It has been in the range of, 7% in Q2.
All right, fair enough. Ramesh, we'll leave it there. Thank you very much. Good luck. Appreciate your time here on CNBC-TV18. As always, we'll take a break here. We'll, of course, heading to the pre-open, which is 4 minutes away. We'll also have Nilesh Shah of Envision Capital for some market chat. It's an important day, and how's Nilesh watching things from here for markets? That conversation on the other side.